think the global economy in general is moving forward, and I think we have to look at financial markets and global economy segmented across areas. So in the United States, we've seen, the prints of GDP, which are over 2%. You adjust them for inflation, though, they're flat. So from the standpoint of economic growth in the United States anyway, there really isn't any. It's fairly anemic. It's not necessarily recessive on any one quarter, but it's definitely not sort of moving leaps and bounds. There are reasons for that, including no strategy for growth in the United States. But if we take a look in other parts of the world, for example, in the BRICS communities, in China, which yes, its growth has slowed, but it is still moving forward. In South America, in Brazil, in areas where there are research-rich, asset-rich components of economies that are driving the future economic growth of those areas, the globe is actually growing economically. From the standpoint of financial markets, obviously we have seen records in the United States. First, it was in anticipation of rate cuts, and then it was because, oh my gosh, we got a 50 basis point rate cuts, yay, what's coming next. But we've seen a number of rate cuts and future rate cut anticipations moving throughout the world as well. People's Bank of China has basically reduced and made less expensive their monetary levels for both consumers as well as for companies within China. So things like that have been going on. The UK has done a couple, Bank of England has done some cuts, the European Central Bank. So we are seeing all this cheapening money around the world. So markets are saying, look, we've managed to go through a period where it was tightening because, it was fighting inflation, which is a separate issue. I do not think inflation can be controlled by central banks, certainly not asset or supply side or demand inflation. But be that as it may, now there's no barrier on that. So even if we get higher inflation, the idea of watching inflation too hawkishly has really been peeled back. So now the markets are saying, okay, whatever happens economically, whatever happens from a labor market perspective, whatever happens from an inequality perspective, we will get fed cheaper money supply by the world's central banks. And that has proven out. It took a couple years, but we're back on that. And that's why they're zooming. And I think they will continue to, albeit we will have periods of volatility. We will have exogenous events. We will have some black swans that could pop up. But overall, this experiment that we've had since the financial crisis of 2008, 2009, which is for central banks to effectively float the debt and the money and whatever growth there may be in their countries, that, despite a small reflection to fight inflation, is back in play. It never really left. The fiscal canon has two spots that it emanates from. It is funded by debt. And what we have seen is, for example, our debt as a country has increased by 7 times since post-financial crisis. We are in a significant period, not just in the United States, but glaringly so in the United States, of debt. And so what has happened is the amount of debt that was created to fund some of the fiscal stimulus that was also created in the wake of COVID has far overshadowed the amount of fiscal stimulus. So even though central banks were there and put interest rates back down to zero, as they did in the wake of the financial crisis, and even though the Fed created up to $9 trillion, they basically doubled the size of their asset book. So what had gone down from a height of $4.5 trillion of an asset book down to 4.1 just before COVID, popped right back up to almost 9, and now we're hovering around 7. There is still a tremendous amount of non-fiscal stimulus that the Fed is basically provided to the banking system and the financial markets. And that's one of the reasons that we have seen the boomerang effect, this bounce back and up effect, even though rates were curtailed from March 2022 to the following July, and now they're being cut again. So again, the amount of fiscal stimulus was much less than the amount of additional debt we continue to have to take on to operate the country. And what's different now as well is that other central banks in this equation, if we look at Collusion, if we look at the overall globe of central banks, have basically said, for example, People's Bank of China, we actually don't want your debt. So when we held more than $1.3 trillion of your debt as a portion or compared to what the Fed had on its books, now we're down to $750. Now we're basically almost cutting that in half. We're buying gold, we're doing other things. But the changing has also occurred in how central banks both support their own domestic systems, how they interrelate, and then how the world effectively works off of central bank largesse. What's happened is, in the financial crisis did catalyze the beginning of it, and then COVID and other events that have happened around the world, is that there's a couple of different policies central banks have had. There's monetary policy, they're setting rates. And the collusion that happened in the wake of the financial system, you're right, we know this. There was a major financial market disaster. Nobody wanted their economies to fall apart. The flow of funds throughout the world to basically keep the financial global system alive, to keep banks alive, necessitated trading in dollars, flowing dollars, having dollar swap lines, having zero interest rates, and printing all that money in different ways around the world. That was required, you're right, sort of honor among thieves, or basically let's all save kind of ourselves, our jobs, our sort of insulated sort of power bases all at the same time, right? And that happened. And now what we're seeing is a different kind of collusion. We still have a lowering interest rate environment, and we still have high assets on books of central banks. But what we're also seeing is a bifurcation of the nature of those reserve assets as we see more of a, I think, bipolar, but as we see different poles in the world. It's not just all about the G7. The BRICS has had a tremendous recently growth in terms of initiation of more members joining, and also trading amongst themselves. So if we move away from monetary policy and reserves, the United States dollar is still the main global reserve currency, but it's lost a significant portion of its reserve currency. It used to be over 70%. Now it's just under 60%. I mean, we're looking at a declining reserve currency balance of dollars. Now that can rise if we have a major financial crisis, again, for the same reasons it did in the wake of the financial crisis. But even with that having happened, it's going down. It's still major, but it's declining. But what is increasing, it's still a small part of what's happening in the world, but what's increasing is trade amongst BRICS countries and amongst sort of different poles outside of the G7. And also some of the G7 countries that are like Japan that are looking for, sort of multi-partners. There's a situation now where a lot of European countries are saying, we can trade with the US in dollars, and we can trade with the Chinese in their currency, in the renminbi. We can do both. And so what's happening is, from a just action of payments, of trade, of all that, we are seeing that 85% of the trade amongst the non-G7 countries, amongst primarily the BRICS countries, is happening in their own currencies. And so this de-dollarization trend, it's not displacing the dollar yet. It's not going to do it tomorrow or in 10 or 20 years, but it has taken more aggressive permutations around the world. One of them is trade, one of them is alliances, and then the third is where real assets come into play, and that includes resource assets, energy assets, and the national security that is associated in the world with having and processing assets in your own national community. I personally don't think that raising rates really was what impacted the inflation spikes that we saw in the wake of COVID, when production and mining and supply chains were basically shut and had to be restarted. So there was a significant amount, both of the growth spike that we saw right after that, as well as the inflation spike, that had nothing to do with the Fed. Where the Fed does have an impact is on anything that requires financing. So for example, raising rates is supposed to reduce the cost of housing and the cost of rent, which it didn't do. So I do think that inflationary pressures will continue to persist. And in terms of real assets, it depends how much they are in need and for how long and in what quantity. So if we look at something like copper, for example, that kind of went down on this idea that China wasn't going to be as economically strong, and then they popped out and so forth, there we see a situation where that's creeping up. And it's also used in so much electrification and so much energy transformation. That's a long-term trend. So even if you got economic slowdowns along the way, the trend is up. And so the inflationary components related to in-demand assets, I think, are baked in. The geopolitical components that come into oil or come into natural gas, when there are issues in the Middle East, when there's additional fighting or, sort of expansion from Russia into Ukraine or wherever else that might happen in the world, that can continue to produce inflationary pressure. So we have two things going on. So yes, I think inflationary pressures in today's world, given the repositioning of the supply chain and the need and demand for things that aren't necessarily all produced and available, will move inflation up on those related items. From the standpoint of monetary policy, does this mean the Fed's going to come in and increase rates again? It could mean the Fed could pause a bit and wait a bit, but the Fed still has to deal with, as other central banks do, the actual economic growth and also the actual labor market. Talk about inequality and so forth. We have seen that the labor market was getting weaker as Powell was focused on inflation instead, and sort of the 50 basis points in one go could be seen as trying to catch up with that. And so I think you can have both things happening. You can have the central bank banks keeping rates the same or cutting rates or even occasionally bringing them up a little bit and still have inflation persisting in general all around us at a higher level than it was sort of coming out of the financial crisis. And before, a lot of this repositioning in terms of real assets, geopolitics and so forth, and trade and other currencies, which are based on real assets, also has become more of a thing. That is true. I mean, my portfolio, my strategies that I'm really focused on right now are not all, but many of them are in the real asset space. And that includes obviously gold for its myriad of reasons, including the fact that it is increasingly a central bank currency, but also geopolitical currency like oil was, and something that can be used as a backstop, not necessarily as a new standard, but for a backstop for trading in bilateral or multilateral currency trading agreements. And we're seeing that more and more. Similarly with silver, which is a use commodity. We're seeing record amounts, for example, of silver imports coming from India, and I wrote a piece about that. But the idea there, and for China, it's got the use in solar technology for energy transformation, and that is happening. If we look at the trajectory of whatever you think of sort of alternative versus traditional energy, there's a significant trajectory in the BRICS countries, in the external world in terms of solar, and also revolutionizing old panels, which requires more silver, right? So there's a demand there. And silver used to be a reserve currency. So there's also the potential, as gold gets more expensive, for silver to be considered a diversifying currency. We didn't think about gold being so much of a diversifier not long ago. But now that we see that that is actually an accumulated reserve component, I can see that happening with silver as well. So that just creates another just buyer set in demand for silver. Copper, not so much going to be a reserve currency, but copper very much in demand. And as the demand becomes more and more, which is for copper, and it's a long-term demand, I can see actually investing not just in copper, but in South America. So we're moving from commodities to regions that have a plenished amount of required real assets. And I'll put on top of that, for example, Brazil, which as a nation, I spend a lot of time there, but also is something that is really jumping up in the BRICS and also the G20 international community because of its net positive energy. So for example, if I look at just from the standpoint of energy efficiency there, what it means by being net positive is they have a lot of energy for solar, wind, hydropower, and so forth. Data centers are moving there. Corporations are moving there. They're looking to process there, not just extract, which used to be how it went. So there's also a switching over of a major, financial technology and other types of AI technology, global companies coming in there, and those are worth a look at, as well as the country. And then uranium, of course, I've been hugely bullish on uranium and nuclear power for lots of different reasons, and as well technology of it, as well as the processing and finding of uranium. And as we've seen a number of major bipartisan acts happen and get passed in the last year and a half that really create nuclear fuel security and other types of advanced technology in nuclear and so forth, and safety mechanisms and waste management mechanisms that are all part of those bills. I see domestic and allied uranium companies doing quite well, as they have been, and also nuclear power itself, and also utilities that sort of ride off of the electrification of everything throughout the world.